passive income. This is what so many of us want to achieve in life. But how do you go about accumulating assets that produce income? What are these income generating and income producing assets that you can acquire so that you can make money while you sleep? In this episode, I'm going to talk about all of this. What are income generating or income producing assets? Income producing assets are investments that produce income consistently on a recurring basis. But before we get in, there are a few things that we need to consider like intelligent investors. The first thing are the risks involved, because all investments come with some risk and you have to establish for yourself what amount of risk you are willing to take. I will talk about the risk profile of all of these investment classes while we go through the episodes. The next one to consider is potential return. When you take a substantial amount of risk, you expect to be compensated handsomely for your risk appetite. And that is where potential returns come in. You need to weigh every asset class against its risk and return profile. The next thing to consider is time commitment. How much of your time on an everyday basis will this asset class require to keep generating income? Some of these assets require as less as hours or days in the quarter to upkeep the asset. But there are other asset classes where you need to spend a considerably high amount of time, energy, and money to keep the asset going. So you want to consider what your time commitment needs to look like to be generating income from these assets. And the final thing that you need to consider is the entry cost, the minimum investment you are allowed to make in that asset category. Because it's all good to say that this matches my risk and return profile and I can commit time to it. However, if it requires you to have $1 million lying around in your bank account, it might not be the asset class that you would want to invest in. All of that said, let's get started. The first category of investments are market related. Within that, the first one are stocks and shares. You would have heard about the Apple stock or the Alphabet stock. Investing in stocks and shares is essentially buying a tiny portion of that company on the stock market. And sometimes companies pay out dividends, and this dividend income is what could generate passive income for you. Some of us who are significantly far away from retirement, we reinvest the dividend back into our portfolios. So if your stocks and shares portfolio is generating £10 or £20 every month, instead of spending and taking that income out, you tend to invest that back into the portfolio. However, if you are much older, you are getting closer to retirement, or you are already retired, you could look at that £10, £20, £50 coming out of a company's dividend as an income. And when you add multiple companies and multiple shares of companies that pay out dividends, this could become quite a lucrative source of income. However, individual stock portfolios are extremely risky. Yes, they could be extremely lucrative as well. The upside is huge. The downside could also be huge on that specific day that you need the money. If you are a long-term investor, it's probably worthwhile to get into some of the bigger blue chip firms. However, for most of us, it is advisable to buy into an index portfolio. What are index portfolios? They are essentially the biggest companies listed on your stock market, and you own a percentage of each of those. So S&P 500 is a good example, right? You have 500 companies listed on S&P 500 and you invest $500 in the S&P 500. So you invest £1 in each of those companies. Some of those companies have their shares going up, some have their shares going down. Overall, you will see that in general, in the long run, S&P 500 will go up and therefore help you produce that income, dividend income, or even actually profit income over the course of years. And that is income that you essentially are making while you sleep, because you don't need to tinker around too much with your portfolio. That is the beauty of index investing, which is why index investing is so popular across the world right now. And I am a big fan of index investing because of the very low time commitment it requires of me. I could rebalance my portfolio once every quarter and be done with it. Additionally, with index investing, there's no minimum amount of money that you need to put in. This is also true for stocks and shares, but if you want one whole stock of Apple, you might still want to shed out whatever is the price of the Apple stock on that particular day. The third thing in this category are bonds. But what are bonds and how are they different from stocks and shares? Stocks and shares help you own a certain part of the company. Bonds are like you being the bank. So you are lending out some money to the government or to the company, and you charge an interest on that. And when I say you charge, I don't mean you really get to charge. Governments and companies put out bonds with a particular interest rate and the face value of that bond. You buy the bond, and every month or every quarter, as per the terms and conditions of the coupon, you are paid the interest. And at the end of the term, so for example, if the term of the loan is 5 years, at the end of the term, you are supposed to get the entire money back. Of course, things are not as simple as that. You could invest in bonds through target retirement funds, ETFs, mutual funds, and so on. So you don't necessarily need to go into the primary market and buy bonds for yourself. You could if you wanted to, but bonds are actually one of the safest investment classes. They pay a lot lesser, but they are much safer. So risk profile is lower than that of shares, but returns are also therefore lower. However, you don't need to spend a lot of admin time on bonds either, and typically the minimum investment is not that high. With all that said, typically you would invest in bonds through a fund, and most retirement funds would increase the proportion of bonds in your portfolio as you approach your retirement date. And then finally, there's certificates of deposits. They are essentially like saving accounts, but you need to put them in for a fixed amount of time. And if you put in for a fixed amount of time, they'll pay you some money. So say for example, you decide to put in £100 for 3 months into a certificate of deposit, and the interest is 5% for those 90 days. So at the end of that term, you'll get £105 back. The risk with this is extremely low, but so is the reward. But the good thing is you probably don't need a lot of money to get started. So this is probably where I'd put my money if you are saving up for something that's coming up in a few months. The second category of income generating assets are property. The first one are rental properties or buy-to-let properties. So essentially you buy your property, you rent it out, and you use the rent to pay off the mortgage on the property. And by the time you retire, you own the property outright, and the rental income coming out of that property is your income. So you don't need to do much work other than maintain the house. And that is the point where I ask, how much work is it to maintain a house? It's quite a lot. And this is why rental properties are not my personal favorite type of income generating assets, but they work for a lot of people, especially when people build a portfolio of rental properties, find a property management company who take care of all of the hassle, and then they just live off the profits. That is their passive income. That is a great way to think about it, but it requires substantial work upfront to build up that portfolio of rental properties. And if you have time and energy to do that, by all means be my guest. However, there are some risks associated with rental property. The first and the most important risk associated with rental property or property in general is you can't pick it up and go. Your land, your house has to stay in that same place. So when it comes to maybe selling the property or realizing your final profits, it might require tremendous amounts of painstaking efforts to actually close a deal. And depending on where the property is and how the political scenario and economy in that country region is evolving, the property prices might not go up as much as other areas. So property is quite illiquid, and that is one of the biggest risks. The rewards could be lucrative, but there are better ways. Real estate investment trusts are a much more sophisticated way of investing in property, but more passively. REITs typically own or finance income generating real estate, and REITs are also listed on the stock exchange. And therefore, when you own a share of a REIT, you automatically get the same income or ownership that is associated for a shareholder for that REIT. But of course, not all REITs are created equal, so the risk profile and the return profile might vary. Do your research before you invest. The next category of property are farmland. Now, this is a really interesting category because obviously this is a source of agricultural income, and across the world, farmland is considered one of the best diversification tools of any investment portfolio. Added to that, because they are farmlands, they are carbon negative. So all of those people who are interested in ESG, ecologically friendly investments, sustainable investments and all of that, farmlands could be very interesting. However, the challenge still remains with farmland. You cannot just pick it up and go. You might not be able to settle the farmland. It's very illiquid. You might need the money and it might be a difficult sale. Along with that, there are a lot of unscrupulous people trying to sell you farmland offshore without you really knowing the quality of the land. So if you buy a farmland in an area that has volcanic eruptions, guess how risky that is? Extremely risky. And guess how much return you'll get out of it? Probably very little. So there are a lot of scams happening around farmlands. Be careful out there, and unless you can go and vet the land yourself, I would stay away from it. In general, my philosophy is less property, more equity, but that's just me. In my personal situation, I prefer that. The next category is one of the hottest categories that are coming up right now. It's business. The first one in that is small businesses. A lot of influencers out there, including Cody Sanchez, talks about owning a part of a business. Naval Ravikant talks about owning a part of a business. This could mean shares, but also there are tons of companies out there who will never get listed on the stock market for various reasons. One could be, well, they run a local mom and pop shop and therefore they have no business doing an IPO. But there are other companies as well which are extremely profitable. They return great income and profits for their investors, and therefore investors are unwilling to let go of those and let the company IPO. Now, that's not every company, that's not every investor, that's not every private equity or venture capital fund. It takes an extremely sophisticated investor to spot good businesses and turn them around to make them even more profitable and therefore income generating. However, when you own a piece of business, the upside is unlimited, depending on the market size of it, but the upside is quite significant. However, when you buy a small business, the risk is tremendously more unless you do a fair amount of due diligence before you buy the business. But even to do that due diligence, it could be expensive in terms of time, energy, and money. So the time commitment that you might have to put in for buying a business and running it could be quite substantial. Also, there is probably a minimum amount of investment that you would need to put in. Most established businesses will at least require you to spend 2 to 3x of EBITDA, and many people might not have it. So this might not be the first category of investments that I would advise to new investors, but then I'm not a financial advisor. The next category are royalties. Royalties are when you write a book or produce a song or produce a movie, and every time someone reads that book or listens to that music, you get paid a tiny percentage of the money that they spent on that book or that music. And this could add up, especially when you are a best-selling author, but not that much. It's not a huge amount, but it's some. It does produce some income. It is passive. However, the time required for you to actually create something that could produce royalty is quite substantial. There are easier ways to make ROI on your time, and one of the easier ways is owning a product. So I know courses and digital products get a beating on the internet sometimes, but if you create a course on something that you are an expert in and share that knowledge out with people in a coherent way that saves them time, you don't have to watch 50 hours of YouTube. You can watch these 5 videos in 3 hours and be done. That is an extremely sensible way of generating income. And they don't necessarily need to be courses. They could be digital products like calendars, could be templates, could be notebooks, could be journals. And you could also think of building SaaS products and software products or apps, etc. Those could be income generating as well, which are probably higher than royalty income, depending on the market that you serve, the price that you charge, and how much ultimately the market takes you up on your offer. The best marketing tool for your own product is, I have realized, your personal brand. So if people know, like, and trust you, they are more likely to buy something from you. And that is where building in equity in your personal brand comes in. Of course, there are other options with personal brand rather than just going the product route. You could go into consulting, you could start a consulting firm. Well, many of the world's top consulting firms were started by people, and those consulting firms are still named after those people who started the firm. For example, McKinsey, for example, PricewaterhouseCoopers, PwC they call it now, and so on. So there are examples out there of what you could do, but you could also land things like speaking gigs, and you can charge money to talk to an audience. So there are ways that a personal brand can help you supercharge your passive income streams. So those are the main categories and income producing assets that you can have in your portfolio to make passive income. Which ones of these do you already have, and which ones are you considering investing in? Let me know in the comments below, and if this was helpful, please like and subscribe, because it does help so much. And if you found this useful, do you mind sharing it out with a friend? That would help them and me, and you'll be a good friend. Thank you so much. And if you enjoyed this, you might enjoy something like this or this that I'll leave up here, and I'll see you the next time. Bye.